The 5 biggest mistakes new investors make. Most new investors don't lose money because the market turns against them. They lose it or leave it on the table because of 5 specific, avoidable mistakes that almost every beginner makes at some point. I've made some of these myself. In the next few minutes, we're going to name all 5, exactly what each one costs, and the simple system that avoids them entirely. Mistake 1 is waiting. Waiting until you have more money. Waiting until the market calms down. Waiting until you feel like you understand it better. It feels responsible. It's actually the most expensive mistake on this list, because the biggest driver of long-term growth isn't picking the right moment, it's time in the market. Someone who starts small at 25 with an ordinary approach can end up ahead of someone who starts later with a much larger amount, purely because of the years of compounding they never got back. Mistake 2 is trying to time the market, waiting to buy until prices drop, or selling because you sense a downturn coming. It sounds smart. In practice, it requires being right twice, knowing when to get out and knowing when to get back in. Professional investors with research teams and decades of data still get this wrong constantly. The realistic goal isn't to outsmart the market's timing, it's to be invested consistently through it. Here's why this mistake is so tempting. Market moves feel obvious in hindsight. Of course it was going to drop then. But in the moment, with no hindsight available, that same information is noise mixed with everything else. Missing just a handful of the market's best days, which often cluster right around its worst days, can meaningfully drag down your long-term return. The cost of guessing wrong is asymmetric, and most people don't realize that until it's already happened. Mistake 3 is chasing whatever's trending as stock everyone's suddenly talking about. A coin, a can't-miss tip from a friend, or a video. By the time something is exciting enough to be everywhere, a lot of the opportunity, if there ever was one, has often already played out for the people who got in early. What's left for latecomers is frequently the risk without the reward. The problem with hype isn't just the odds, it's the emotional cycle it creates. You buy because you're afraid of missing out, then it drops, and you sell because you're afraid of losing more. That fear-driven in and out pattern is close to the worst possible way to invest, because you're buying high on excitement and selling low on panic, the exact opposite of the goal. Mistake 4 is concentration, putting most or all of your money into a single stock or a single sector because you're confident in it. Confidence isn't the same as certainty, and even great companies have bad years. Leadership changes or unexpected setbacks. When your money is spread across many companies instead, no single disappointment can sink your entire plan. We cover this in full in our index funds video. Here's what makes this mistake sting in hindsight. It's completely avoidable, and it doesn't cost you any upside to fix. A broad, diversified fund still owns the winners. You're just not betting the entire outcome on correctly guessing which company that will be in advance. Diversification isn't playing it safe out of fear. It's removing a risk that was never necessary to take in the first place. Mistake 5 is ignoring fees, specifically the expense ratio, a small percentage taken from your investment balance every year. On paper, 0.5% versus 1.5% looks trivial. Over several decades, that gap can quietly consume a meaningful share of your total growth, because you're not just losing the fee, you're losing everything that fee would have gone on to compound into. There's a 6th mistake hiding underneath most of the others: panic selling when the market drops. A decline is a normal, expected part of investing. It has happened repeatedly throughout history, and has also recovered repeatedly. Selling during a drop is the one move that turns a temporary paper loss into a permanent real one. Look at all 5 together, and there's one thread running through them. Every one of them is driven by emotion, in the moment, impatience, fear, excitement, overconfidence, or simply not looking closely enough, rather than by a plan decided in advance. None of them require bad luck, they just require reacting, instead of following a system. Here's the system that quietly fixes all 5 at once. Start now, with whatever amount you have. Automate consistent contributions, so you're never trying to time anything. Keep the core of your portfolio in broad, diversified funds. Check the expense ratio before you invest in anything, and decide in advance while you're calm that you won't sell during a downturn. The reason this system works isn't complicated, it's just rarely written down. Take 5 minutes and actually write your plan on paper. How much you're investing, how often, and a simple line that says "I will not sell" because of a headline. Decisions made in advance, in writing, are far easier to stick to than decisions made in the middle of a stressful moment. So here's your action list. Check whether you're actually invested or still waiting for a better moment. Look up the expense ratio on any fund you own. Confirm your contributions are automated rather than manual. And if you're holding a single stock that makes up most of your portfolio, Ask yourself honestly whether that's confidence or convenience. Let's recap. Waiting for the perfect time, trying to time the market, chasing hype, staying concentrated in one place, and ignoring Fee's 5 mistakes. All avoidable, all driven by emotion instead of a plan. Fix them with one simple system. Start now, automate, diversify, watch the fees, and decide in advance to stay the course. If this helped, follow Liberty Wealth Insights for more financial education, made simple, in plain English, no jargon. We'll see you in the next one.